Howdy, Jacob here. Today we're looking at Artisan Partners Asset Management in the capital markets industry, 3 billion market cap and enterprise value. Founded in 1994, based out of Wisconsin. They're a publicly owned investment manager. They provide services in pension, profit sharing plans, trust endowments, and such. Their growth has been very limited, 829 million in 2014 to 975 million in 2023, with huge drops post COVID, but fairly normalized in comparison to pre COVID levels. Margins on both gross and operating are actually down. Same with return on invested capital. That's a pretty negative sign for me. The balance sheet shows 178 million cash on hand with 199 million in total long-term debt. So it's not a whole lot of net debt, maybe 20 million, and they can more than afford that. So from a balance sheet perspective, very safe company. Their cash from operations are well above their capital expenditures, but they are declining and down quite a bit from what they were 10 years ago. And their use of cash is a little bit of reinvestment and then paying out the dividend. The dividend is currently maybe 60% or so of their 5-year average free cash flow. So let's start making some assumptions here. It looks like they're fine with this dividend being where it's at, or I'm fine where this dividend is at. They were pretty consistent over here pre-COVID at 240, and it's right around there. And I'm still leaving a little bit of money to hopefully buy back shares if they get stupidly cheap or reinvest back into themselves in some sort of fashion. Their growth, I don't think, is going to be that crazy. Maybe 2% growth, 12, since they're really not although they do still have 20% return on invested capital, they're not reinvesting back in themselves very heavily, and so you're not going to really get that 20% return since they're just paying it out in a dividend. And so on the margin side, I do like that free cash flow is quite a bit higher. Maybe let's do 25, 30, quite a big range. And then they've been increasing shares likely through share-based compensation. It's only 34 million, but it is in relation to that. So let's do 1% increase there. And we're saying that even with the assumptions, it still has to fall a little bit before you get the 15% return we're looking for. So I'm going to wait a little bit before I do more research. I don't like that the company's been issuing so many shares. I don't like that both gross and operating margin are down and that the business is relatively flat. And so I wouldn't say this is one of the better businesses that we've looked at in this screener, but still any investment can be a great investment at the right price. But I don't think we're there yet. So hopefully you have a great rest of your day. Thank you.